Welcome to Mortgage Industry Terminology for Loan Officers. Understanding the language of mortgage lending is essential for effectively communicating with clients, colleagues, and industry partners. In this training, we'll cover the key terms you need to know to navigate the mortgage process confidently. Let's start with fundamental loan types. A conventional loan is a mortgage not insured or guaranteed by the federal government. These loans typically require higher credit scores and larger down payments, but offer competitive rates for qualified borrowers. Conventional loans can be conforming, meaning they meet Fannie Mae and Freddie Mac guidelines, or non-conforming if they exceed these standards. FHA loans are insured by the Federal Housing Administration. These government-backed loans allow lower down payments, sometimes as little as 3.5%, and accept lower credit scores. FHA loans require both upfront and annual mortgage insurance premiums, which protect the lender if the borrower defaults. VA loans are guaranteed by the Department of Veterans Affairs and available to eligible veterans, active duty service members, and surviving spouses. VA loans offer significant benefits, including zero down payment requirements, no private mortgage insurance, and competitive interest rates. The VA funding fee helps offset the program's cost to taxpayers. USDA loans are backed by the United States Department of Agriculture for rural and suburban homebuyers who meet income requirements. Like VA loans, USDA loans can offer zero down payment options but require both upfront and annual guarantee fees. Now let's discuss key financial terms. Principal is the original loan amount borrowed, not including interest. As borrowers make payments, the principal balance decreases. Understanding principal is crucial for calculating equity and explaining amortization to clients. Interest is the cost of borrowing money, expressed as a percentage of the principal. The interest rate directly affects the monthly payment and total cost over the loan's life. Borrowers pay more interest in the early years of a mortgage, with more going toward principal as the loan matures. Amortization is the process of paying off a loan through regular payments over time. Each payment includes both principal and interest. An amortization schedule shows how each payment is divided and how the loan balance decreases over time. Fully amortized loans are paid off completely by the end of the term. Escrow is a neutral third-party account that holds funds for property taxes and homeowners insurance. Lenders often require escrow accounts to ensure these critical expenses are paid on time. Monthly mortgage payments include principal, interest, taxes, and insurance, commonly abbreviated as PC. Let's cover important ratios and calculations. The debt-to-income ratio, or DTI, compares a borrower's monthly debt payments to their gross monthly income. Lenders use DTI to assess a borrower's ability to manage monthly payments. Front-end DTI includes only housing expenses, while back-end DTI includes all monthly debt obligations. Most conventional loans require a back-end DTI below 43%. Loan-to-value ratio, or LTV, compares the loan amount to the property's appraised value. A lower LTV indicates more equity and less risk for the lender. Borrowers with LTV ratios above 80% typically need private mortgage insurance. Combined loan-to-value, or CLTV, includes all loans secured by the property, such as first and second mortgages. Private mortgage insurance, or PMI, protects the lender if a borrower with less than 20% down payment defaults. PMI typically costs between 0.5 and 1% of the loan amount annually. Borrowers can request PMI removal once they reach 22% equity through payments or appreciation. Understanding appraisal terms is essential. An appraisal is an independent professional assessment of a property's market value. Lenders require appraisals to ensure the property's value supports the loan amount. The appraised value may differ from the purchase price, affecting loan approval and terms. Comparable sales, or comps, are recently sold properties similar to the subject property in location, size, condition, and features. Appraisers use comps to determine fair market value. Understanding how appraisers select and adjust comps helps you set realistic expectations with clients. Let's discuss closing and settlement terms. Closing disclosure is a 5-page form that provides final details about the mortgage loan, including loan terms, projected monthly payments, and closing costs. Borrowers must receive this document at least 3 business days before closing, giving them time to review and compare with the initial loan estimate. Title insurance protects against losses from defects in the property's title, such as liens, encumbrances, or ownership disputes. Lender's title insurance protects the lender's interest, while owner's title insurance protects the buyer. Title insurance is typically a one-time premium paid at closing. Recording fees are charges for filing the mortgage and deed with the local government to make the transaction part of public record. These fees vary by location and are typically paid by the buyer at closing. Understanding underwriting terminology is crucial. Underwriting is the process of evaluating a loan application to determine risk and decide whether to approve the loan. Underwriters review credit history, income documentation, assets, and property value to ensure the loan meets lending guidelines. Automated underwriting systems, or AUS, use computer algorithms to evaluate loan applications quickly. Fannie Mae's Desktop Underwriter and Freddie Mac's Loan Prospector are common systems that provide preliminary approval decisions based on submitted data. Conditions are requirements the underwriter sets that must be satisfied before final loan approval. Common conditions include verification of employment, explanation of credit inquiries, or additional documentation of assets. Clearing conditions promptly keeps the loan process on track. Finally, let's cover some additional important terms. Origination is the process of creating a new loan, from application through closing. The origination fee compensates the lender for processing the loan and is typically 1% of the loan amount. Points can refer to either discount points, which buy down the interest rate, or origination points, which are fees for processing the loan. 1 point equals 1% of the loan amount. Understanding the difference helps you explain costs accurately to borrowers. Prepayment penalty is a fee charged if the borrower pays off the loan early, either through refinancing or selling the property. While less common today, some loans include prepayment penalties to protect the lender's expected interest income. Always disclose prepayment penalty terms clearly to borrowers. Now let's explore specialized loan products for real estate investors. DSCR loans, or debt service coverage ratio loans, are non-qualifying mortgages designed for investment properties. Unlike traditional loans that focus on the borrower's personal income, DSCR loans qualify based on the property's rental income. The debt service coverage ratio compares the property's monthly rental income to its monthly debt obligations. A DSCR of 1.25 means the property generates 25% more income than needed to cover the mortgage payment. These loans are ideal for real estate investors with multiple properties or complex tax returns who may not qualify for conventional financing. Fix and flip loans are short-term financing solutions for investors purchasing properties to renovate and resell quickly. These loans typically have terms of 6 to 18 months and higher interest rates than traditional mortgages. Lenders evaluate both the purchase price and the after-repair value, or ARV, to determine loan amounts. Fix and flip loans often include a renovation budget dispersed in draws as work progresses. These products suit experienced investors who can complete renovations efficiently and sell properties within the loan term. New construction loans finance the building of a home from the ground up. Construction to permanent loans combine construction financing and a permanent mortgage into one transaction, eliminating the need to refinance after completion. During construction, borrowers typically make interest-only payments on funds disbursed. The loan converts to a standard mortgage once construction finishes and the certificate of occupancy is issued. These loans require detailed construction plans, qualified builders, and regular inspections throughout the building process. Non-qualifying mortgages, or non-QM loans, don't meet the Consumer Financial Protection Bureau's qualified mortgage standards. These loans serve borrowers with non-traditional income sources, recent credit events, or unique financial situations. Non-QM loans may accept bank statements instead of tax returns for income verification, allow higher debt-to-income ratios, or finance non-standard properties. While these loans offer flexibility, they typically carry higher interest rates and require larger down payments than qualified mortgages. Understanding non-QM options helps you serve self-employed clients, real estate investors, and borrowers rebuilding credit. Let's test your knowledge with some quiz questions about these specialized loan products. Question 1. What does DSCR stand for, and what does it measure? DSCR stands for Debt Service Coverage Ratio. It measures the relationship between a property's rental income and its monthly debt obligations. A DSCR of 1.25 means the property generates 25% more income than needed to cover the mortgage payment. Question 2. What is the typical loan term for fix and flip financing? Fix and flip loans typically have terms of 6 to 18 months. These short-term loans are designed for investors who can complete renovations quickly and resell the property within the loan period. Question 3. How do construction to permanent loans benefit borrowers? Construction to permanent loans combine construction financing and a permanent mortgage into one transaction, eliminating the need to refinance after completion. This saves borrowers time, money, and the hassle of going through the loan process twice. Question 4. How do non-QM loans differ from qualified mortgages? Non-QM loans don't meet the Consumer Financial Protection Bureau's qualified mortgage standards. They offer more flexibility for borrowers with non-traditional income sources, accepting alternatives like bank statements instead of tax returns. However, they typically carry higher interest rates and require larger down payments than qualified mortgages. Question 5. Who are DSCR loans ideal for? DSCR loans are ideal for real estate investors with multiple properties or complex tax returns who may not qualify for conventional financing based on personal income. These loans focus on the property's ability to generate rental income rather than the borrower's personal financial situation. You now have a solid foundation in mortgage industry terminology. Mastering this language enables you to communicate professionally, build client trust, and navigate the lending process effectively. Continue expanding your vocabulary as you encounter new terms in your daily work.